Welcome to Market Monkeys. Today we're going to be talking about PE ratio and earnings per share.
Just so you get an idea of what they are. I know a lot of people use this terminology, Scott, and a lot of people don't understand what it is, and
maybe they do, maybe they don't, but yeah, we're
gonna tell you anyway.
Clear it up. Yeah. Right. So basically, earnings per share is what a lot of people are looking at. That's the trailing past 12 months. That's when you see it TTM. So trailing 12 months. You're looking at that there, and that gives you the overall amount that they've earned for the past 12 months. Then you can divide that by the share price. That'll give you your PE ratio. So how many times the earnings you're actually paying for the company. When you see companies that are between, say, 5 to 10, PE ratio of 5 to 10, so then basically what you're looking at is you're paying 5 to 10 times the earnings of that for that company, right?
That's correct.
So when you see in a company, and you hear a lot of people saying, when it's priced between 10 to 15 PE ratio, that's a good price. And when you see a company when it's above 30 times earnings, then it's way overvalued. But
not necessarily.
Not necessarily. So this is where I want to just clear some things up. The PE ratio really gives you an idea of where people think things are going. So when you see a higher PE ratio, a lot of people are thinking that the company is going to be very optimistically going forward, growing very quickly. Yeah. So the higher the PE ratio, the more optimistic the market is based on the growth of the company in the future. When you're seeing a company between 5 to 15 times earnings, you're looking for a company that's going to be growing. It gives a little bit of a dividend. It's more established. It's just tickering over basically.
Yeah.
When you start looking around 20 to 30, then you start seeing higher growth. You're looking probably around 35% you'd be expecting in growth per year.
Well, that's what the analysts are expecting.
Right, so this is not a dead-on accurate thing, it's just a guide. So that's what you're probably going to be looking around. When you start seeing, when you see these big tech stocks in America, where they're at 60, 80, 200 times earnings, they are expecting unbelievable growth in these companies.
Yeah.
Right?
They're not dividend stocks, they're growth stocks.
They're pure growth. Every single dollar they have is going to be reinvested in the company.
Back into equity.
So there's not going to be any dividends. Yeah. All the money is just going reinvested straight back in to continue at the high margins that they're able to produce.
And what the analysts are expecting from that is quarter on quarter, huge growth.
Absolutely, yeah. And you'll see, it'll come up before the earnings, a lot of these big companies, they'll say analyst expectations, and then when you see these big jumps or big losses, that'll be based on what the analysts were expecting. So, if they say, we're expecting 80 cents for this quarter, and they come out and they say analyst estimate will beat by 20 cents. That's huge. That's a 25% increase above what analysts were expecting to have. That's when you see a massive jump. Now,
and we all know analysts are always correct. That's why we're doing it ourselves.
You know what? On the whole, they're not too bad. They're not. You know what? A lot of analysts, it's hard to predict earnings.
It is.
It's very difficult.
And with, they've got the economies of nations and things all come into play. Lots of things.
There's lots of things. Wars go on, things like that. So basically, what you got to look at when you're looking at PE ratio, it's not just because that's obviously in the past. But now what they're doing is they're pricing in what they think is going to be coming in the future.
Yeah.
So they're looking at what has happened, and then they're taking into account what the company is now looking to do, what it's done before, and what it's been able to accomplish by what it said that it was able to do before and done it. Now looking forward, saying what are they looking to do now? The likelihood that they're going to be able to do it, being that they've accomplished their prior things that they said they were going to do, is quite high. So what happens is the company starts to get bid up, especially when the prospects are looking very, very good. So when they start saying, we're going to be able to increase our revenue the next year by 80%, and they've done it the past 3 years, everybody believes them. And think, well, why wouldn't they be able to do that? They've got the business model in line. Everything's been working out fine so far, so why can't they keep continuing on doing that?
It also depends on the companies as well, because sometimes there's a lot of analysts following certain companies, and the more analysts you've got researching them, a higher caliber analysts, like from major banks and things like that, people do pay attention to those, and
Yeah,
they
they do.
They do buy on that information.
They do, yeah. So basically with the PE ratio, what I'm saying is that a lot of it depends on the growth. So when you're seeing a company that's 30 to 40 times earnings, like the PE ratio, you're looking at a company that's going to be able to grow.
Yeah.
Basically, you're looking at a higher growth company than what it would be if it's just stagnant around, if you're looking at 19 to 25. And you'll see a lot of these companies they'll actually vary in the PE ratio. It'll vary through the year, where they're very, very highly expected to be growing much, much quicker.
Mm-hmm.
Then other times it'll slow off, and you'll go from, say, 60 times earnings, it'll go down to like 38 times earnings, and then when they start to pick up again, when everybody's saying something new, some new information's come out, then it'll start to be bid back up again to around maybe 60 or 70 times earnings, and that's how it works.
And sometimes in what can come into play is some companies are cyclical.
Yeah, but usually cyclical company, you're going to be looking around no more than, I would say, around about 20 PE ratio, because everybody knows that at some point they will take a dip. With companies that are not cyclical, usually they get bid up to a lot higher point.
So that's PE.
So that's the PE ratio. Yeah, leave some comments down the bottom there, and maybe we can answer some questions, and that'd be fantastic.
If you're not quite getting it, ask us some questions. Yeah.
Maybe I could explain something a little bit differently. Maybe I've missed something you'd like to know about.
Earnings per share.
Earnings per share.
Yeah, you were talking about that.
There you go. Yeah. So leave us a comment. So thanks very much. Subscribe.